Welcome to the deep dive. Today we are cracking open an institutional analysis of ICICI Bank.
That's right.
Our mission is really to take the stack of, well, quite specific reports and figure out if this huge Indian lender is actually the long-term, buy and hold opportunity the sources seem to think it is.
Yeah, the real deal.
Okay, so let's unpack this a bit. The core idea we're digging into here is this pretty profound institutional turnaround happened after 2018.
Right.
The claim is the bank went from having, frankly, some real governance issues and shaky asset quality.
Suddenly becoming, best in class.
Yeah.
That's the term they use.
And that's absolutely central. Our job really is to see if this change is, structural, built to last for maybe a decade.
Or just good timing.
Exactly. Or just cyclical luck. The key idea, the philosophy change they talk about, is moving away from just aggressively chasing return on capital.
Which is like growth at all costs.
Pretty much, maximizing expansion.
Yeah.
And shifting towards prudently prioritizing return of capital, meaning risk management comes first. Protect the downside.
Precisely. Risk first.
And the big proof point for this risk-first idea is supposedly this fortress-like balance sheet. The numbers show a net non-performing asset ratio. That's the bad loans after provisions at just 0.39%, which sounds incredibly low, almost too low. How sure are we this isn't just like a temporary low after a big cleanup?
Well, that's the right question to ask. You need that skepticism. But the overall operational performance seems to back it up.
Okay.
The bank's really emerged as the profitability leader among its big private peers. Look at their return on assets, ROA.
How well they use their assets to make profit.
Exactly. It hit 2.30%. Now, what's really interesting is comparing that to, say, HDFC Bank. They reported 1.75%.
Wow. Okay.
Yeah.
That ROA gap is pretty significant. So, right, how are they doing that? How are they keeping that profit edge?
Yeah.
The sources seem to point straight at this bank tech pivot, a huge investment in a single platform, right, called ICRM.
That's the one. They see it as the tech that creates one ICICI Bank customer view, unifies everything.
The crown jewel, almost?
You could say that. This single view gives them a massive strategic advantage. It allows for what they call the 360-degree customer approach.
Knowing everything about the customer.
Basically, yes. Which lets them cross-sell really effectively, especially those capital-light fee income products, things like credit cards, wealth management.
Stuff that doesn't tie up much capital.
Correct. And that fee income part has been growing consistently faster than their core net interest income, the NII. The basic money from lending.
Okay, that makes sense. And you can actually see this risk-calibrated approach in the loan book data itself, can't you?
You can.
They deliberately moderated growth in retail loans. That's often seen as a bit higher risk, slowed it way down from almost 20% to like 6.6% year on year.
Right, pull back there.
While at the same time, they accelerated growth in business banking and the SME segment, small and medium enterprises. That went up nearly 25% year on year.
Which taps right into India's whole economic formalization trend. Lower risk, arguably, with better data trails now.
Smart move.
It looks sound strategically.
Yeah.
But we absolutely have to talk about the most likely near-term risk.
Okay, what is it?
Despite all this strength, the big one is probably net interest margin, or NIM contraction.
Their profit spread on loans.
Exactly. Across the whole banking sector, loan growth is running faster than deposit growth right now. That creates funding pressure, and it threatens that really strong 4.30% IM they have.
Right, deposits getting more expensive. But what about the safety net? This seems crucial in the reports.
It is.
They highlight this massive provision buffer, a war chest they call it, over 13,000 crore rupees.
13,100 crore, yeah. About $1.5 billion US dollars, built up during the good times.
And just to give you a sense of scale there, that buffer is apparently big enough to absorb major stress in their entire unsecured retail book.
Which is significant.
Without even having to dip into future quarterly profits to cover it. That's serious resilience.
Absolutely. And connecting that resilience to the bigger picture, the macro story. It positions them perfectly for these huge decadal tailwinds in India.
Okay, what are those?
Well, first, there's India's massive credit-to-GDP gap. The ratio is only around 55% of GDP.
Compared to?
The world average is nearly 150%. So India is way behind. This isn't just a short cycle. It's potentially a 30-year structural catch-up. Huge room for credit growth.
A massive runway. And the second tailwind.
It's that formalization and digitalization flywheel we touched on.
Right.
As more businesses become formal, they leave digital trails. That allows ICICI's tech platforms, like that ICRM, to actually underwrite SMEs that were previously unbankable.
Expanding the credit-worthy pool massively.
Exactly. That's what's driving that SME loan growth we saw.
Okay, so bringing it all together, given this high base they're starting from now and this clear management shift towards being more prudent, what's the realistic outlook?
Well, the analyst consensus seems to be that, look, the days of 30+% growth are probably over. That was the recovery and turnaround phase.
Right? Unsustainable long term.
Yeah. The more realistic baseline now, maybe for the next 5 years for earnings growth, that's profit after tax, PAYG-R,
Compound annual growth rate.
is likely in the 12 to 14% range. Still very healthy, but reflects that prudence and the much higher earnings base they have now. Sustainability over just chasing spikes.
So let's boil this down. What does this mean for you, the listener? You've got this micro story. Best-in-class management, great tech, solid profitability.
Ticking the internal boxes.
And it seems perfectly lined up with the macro story, India's long-term structural credit growth. Now, the stock does trade at a premium valuation.
It does, yeah. It's not cheap on paper.
And maybe that premium isn't really for crazy growth anymore. Maybe it's the cost of trust. So the final thought for you is this. Is paying that higher price today for a bank you now believe is managed ethically, prudently, for the long haul, a true governance premium, is that actually the smart price to pay to avoid the risks of the past? Something to think about.